Should you still buy the NASDAQ 100? Here's my take. This is one of the most frequently asked and hotly debated questions in investing right now. Today, I'll break it down for you. First, we need to be clear about what we're actually talking about. The NASDAQ 100 isn't just any company listed on the NASDAQ exchange. It's a carefully curated selection of the 100 largest non-financial companies traded there. Its core characteristics are very distinct. Technology is king. It's a concentrated portfolio of the world's leading companies in tech, internet, and biotechnology, the giants driving the new economy. Home to the Magnificent Seven. You've heard of the star players like Apple, Microsoft, and Nvidia. They are all in here, and they carry enormous weight, meaning their performance heavily influences the entire index. So, where does its investment value lie? The fundamental logic is simple. It allows everyday investors to buy into the core engine of global technological innovation with a single click. We are living in an era driven by AI and cloud computing, and investing in the NASDAQ 100 is like buying a ticket on that express train. Historical data confirms its exceptional long-term growth and returns, which consistently rank among the best of all major global indices. These mega-cap companies have incredibly strong profitability and wide economic moats. By investing through a related ETF, you also achieve a certain level of diversification. However, a crucial warning: high return potential always comes with high risks. And when it comes to risk, the NASDAQ 100 has some standout features. It's very, very expensive. Let's look at the latest data. As of April 4th, 2025, its price-to-earnings (PE) ratio has reached 37.16x. What does this mean? This places it in the 91.16th percentile of its 10-year valuation range. In plain English, it's more expensive now than it was over 91% of the time in the past decade. This alone is a red flag requiring our full attention. High volatility and interest rate sensitivity. At these lofty valuations, the index becomes highly volatile and extremely sensitive to interest rates. Any hint of the Fed raising rates puts immense pressure on these tech stocks, which are valued heavily on their future cash flows. Concentration risk. While it's called the 100, its fate is largely tied to its top 7 to 8 holdings. The concentration risk is significant. If just one or two of these star companies disappoint on earnings, the entire index could take a hit. So, what should we do with this alluring yet richly valued index? My view is that strategy is more important than conviction. First, absolutely do not go all in. At current levels, a large, one-time investment carries far too much risk. So what's the alternative? I believe dollar cost averaging, DCA, remains a useful tool, but the logic behind using it now must change. The primary goal isn't to chase gains, but to guard against a potential future decline, using time to smooth out your average cost basis. You could also consider slightly reducing the amount you invest each period. Portfolio control is paramount. The NASDAQ 100 should not be the cornerstone of your portfolio right now. It's better suited as a satellite allocation, and you must keep its proportion in check. Embrace patience and cash. In times like these, holding cash and being patient is not a bad thing. Think of cash as an option waiting for a better opportunity. It's perfectly reasonable to have a more opportunistic plan. For instance, patiently waiting for a meaningful market pullback and then acting decisively when valuations become more attractive. In summary, the long-term story for the NASDAQ 100 remains compelling. But in the short term, with valuations this high, defense is far more important than offense. For us as investors, staying cautious, controlling our exposure, using DCA wisely, and patiently waiting for better opportunities is likely the most intelligent approach right now. Alright, that's all for my breakdown of the NASDAQ 100. Thank you to everyone for your likes, saves, and follows.